we are all facing is quite apparent. I don't think, unless any of you have a crystal ball in front of you right there, this is going to be a tough one, right? There's very likely to be scenarios that we will have to talk about, how soon this will lift, how soon those coronavirus medications, how soon that coronavirus, how soon the region, etc., and the health crisis can be dealt with. We don't know for sure what this new normal is, and just like everybody else out there, this panel is also this panel will also have to struggle with the realities of that challenge. So let's appreciate that. But I would also encourage everybody here to nonetheless dive in, give us those scenarios, don't hold back on those scenarios. I'll quickly introduce everybody around the screen for you, right? First off, Danushka Samarasinghe is Chief Executive of Softlogic Capital Markets. Danushka, can you give us a little wave so we know who we are?
Hi everyone.
That's Danushka. Then we have Chethana Ellepola, who is Director of Research at Acuity Stockbrokers. Chethana.
Hi everyone.
And then we have Nikita Tissera, Head of Research at Bartleet Religare Securities. Yes, Nikita.
Hi.
And then we have Dimantha Mathew, Head of Research at First Capital. And Dimantha is part of First Capital, which is both a stock brokerage and also a bond dealership. So he's got a view here covering two asset classes quite well. And so has Udeeshan. Udeeshan Jonas is Senior Vice President at Capital Alliance, or CAL as we now call it. Udeeshan, again, just like Dimantha, covers two asset classes, I think, in your work, right, Udeeshan, more or less?
Yes, both fixed income
and equity, right? Okay, for everybody else out there, how you can, if you are on Zoom, you can post your questions directly onto Zoom. There is a Q&A function, just post the questions there. Right. If you are not on Zoom, I'd highly recommend that you get on Slido, slido.com. The hashtag or the username or the sort of event name is decode. Get onto slido.com, put decode in, and you will immediately be taken to where you can ask questions and you can see what everybody else is asking about, and also vote up those questions that you think this panel needs to be dealing with. We are trying to do a conversation here also. I would encourage everybody out there to participate, and also the panelists to sort of interact with each other if possible, right? And have a conversation about what the future of... so we're trying to answer four broad questions: what the macroeconomic outlook is, what the outlook for fixed income securities are, what's the outlook for listed companies, listed stocks. And I think most of these the analysts around this table have a limited number of stocks they're covering. The most liquid, largest companies usually, it could be anything from 20 to 30 companies. So they'd have a sharp idea about those, and they'd certainly have good views about sectors, etc. And the fourth question, if you can at this point try to answer that, is, what do you do with the portfolio right now? How do you allocate a portfolio in this climate? Right. We'll start with the opening remarks from everybody around the table here. They'll probably take 2 to 3 minutes. Talk about our first thing, the first topic we want to discuss, which is the macro outlook. Maybe 2 to 3 minutes is enough to put a couple of ideas across. So without much further ado, I'll ask Chethana to kick this off. Chethana, over to you.
Thanks, Shamindra, and good morning, everybody. normally forecasting for lists is particularly something like GDP is relatively straightforward. This is not to say that it's easy, but it's basically our bread and butter, and we have a reasonably good sense of where the economy is going to go, even after crisis situations like the Easter terror attacks, right? But forecasting for this year, for 2020, and the next 12 to 18 months has become incredibly difficult. And I know this has become a cliche, even Shamindra just mentioned it. It is an unprecedented situation, right? And this is not to say that we haven't dealt with crisis before, but just to sort of give you some sense of what it is like to forecast during these times. It's almost like taking the tsunami, the global financial crisis of 2008, and the Easter terror attack, rolling them all into one, and then, put in the impact of that, not just on all the sectors in the Sri Lankan economy, but across the world. So that's the level of sort of uncertainty and intensity with which we're dealing with right now. And so like Shamindra also mentioned, as analysts, the only thing we can really do is work with scenarios and timelines, right? So, I'd be happy to take on any questions about what our actual assumptions are in each of these, but just to sort of keep it brief. We have a couple of scenarios, and I'd like to just take you through those, right? So in a best case, or most optimistic scenario, where we see a sort of V-shaped recovery in the economy, we are looking at a GDP growth of about 1.5% for this year, right? And the assumption that we make in this scenario is that, yes, we have this sharp shock from the COVID-19 impact, impacting some of the key sectors across the economy. But the recovery, it lasts for maybe about a quarter, and this economy starts to sort of chug back up, right? And it's in that case that we estimate something like about 1.5%, and well, that's lower than the 2.5% of last year. You can see why it's not necessarily a bad place to be, given the sort of significance of the shock to the economy, right? However, we don't really feel that that is the most likely case. What we feel is that growth is more likely to be in the negative 3 to 4% range. And what we're assuming in that scenario is that unlike other crises where, unlike most other crises, not everyone, but unlike most of the crises where the impact is sort of, limited to maybe a quarter or maybe 2 quarters, in the COVID-19 case, we expect it to sort of be contracted. You're going to get contractions throughout several quarters. And in that scenario, we expect the GDP growth to fall to about 3%. And if it's even further worsened, let's say there's a second wave and that we have extended lockdowns, let's say that there are further bankruptcies and further issues in the economy, in that situation, we could even be looking at something like a negative 5 to 6% drop in GDP. Now, I know these numbers are scary. I know they're daunting because, in the history of Sri Lanka's GDP, we have only really seen negative growth rates twice in our history, the latest being in 2001, when the drop was about 1.4%. So I do understand these numbers can be a little bit daunting, but it is important to sort of put it in context, because if you look at, arguably more stronger economies such as US and Europe, even they're forecasting something like a 6 to 7% drop. And if you look at the sort of growth engines of the last decade, which is China and India, even those economies are sort of estimating a drop to about 1 to 2% growth this year, from about the 6-7% growth rates that they've been experiencing. So that's the sort of context that we're working with, and that kind of gives you a sense of why why Acuity is saying, looking at the numbers that we're sort of looking at. And I don't mean to sort of be doom and gloom, but I think it's best for us to sort of have a sense of what the possible scenarios are, so that we can then, like you mentioned, Shamindra, decide how best to sort of allocate our portfolios and what kind of risk appetite we should have. So yeah, over to you, Dimantha. I think you're next.
Okay, so I think it's great that you guys are upfront, right? So we are looking at minus 3 to 4%. It could go to minus 6%. This is, I think, since GDP has been tracked in this country, this would be unprecedented. I think we've been tracking GDP since 1955 or 52 or something like that, right? That would be unprecedented to have a contraction of that size. I'd like to see if everybody else could also weigh in on their opening remarks on what their forecast GDP for this year is. Danushka, can you go next?
Hi everyone. Chethana, thanks for those opening remarks. We also share this somewhat similar view, right? If I'm to just to drum in the gravity of this scenario, I don't think any one of us or in the past two generations had experienced something like this. So earlier we have experienced economic cycles, the global economic cycles, but never before have we experienced a global economic downturn coupled with the health crisis. So it's basically uncharted territory. So we have to, I think, accept that reality. And the tricky situation here is it's all dependent on how quick a cure or vaccine for the COVID-19 virus can be mass produced and made globally available. So that is the point where the global economy can basically bounce back. So I think Chethana mentioned about the V-shaped recovery, right? Even it could, we think it could be a U-shape even if the vaccine is being made available to the entire world, which could be unlikely. So we are basically in this sort of slow growth scenario for a bit of time until this virus crisis can be addressed. So that is the main downturn. But if I'm to just give you a more of a helicopter view, what happened was, the global economy was growing continuously, and we all know that the economic cycles are in play. So there was a sort of a slowdown which was due for some time, and this virus basically triggered that, and all the other problems which the global economy had sort of like all came together with this, and the impact became severe. And also we should be mindful that the global economy is integrated like never before. So that created the slowdown. So it's not only Sri Lanka, it's the entire globe which is slowing down. So that is one consolation factor, because if we were one outlier, it would have been very difficult for us to come over this or get over this. But now it's not only us, it's the entire global economy. So it's a common phenomenon. So I think that is sort of somewhat of a relieving factor for us. But then coming back to Sri Lanka, yes, we have our own set of problems coupled with this health concern and the inability to connect with the global economies. Our supply chains are disrupted, demand has contracted, all that is there. So we are facing, similar to any other economy, we are facing issues in three sides. One is GDP growth. The other one is basically our fiscal position is not enabling us to give the relief some other developed economies can give the economy. And because of these reasons, there is demand contraction or destruction happening in the economy. So we have to face all these three. And on top of that, a non-economic factor is basically the health concern and how we can address that. And if it is not addressed, it will become a prolonged economic deterrent for the country. So on that premise, we also think in our most optimistic case, Sri Lanka's GDP growth will not grow beyond 1.1% in 2020, right? And most likely scenario would be it will be in negative territory. So but I need to highlight the point, Shamindra, that we are not alone. The entire global economy will contract, and even China is on the brink of just growing or recording negative growth. So those are the facts. And if India can lock down its economy for over 1 month, it shows the gravity of the problem. So we are not alone. But with this, what will happen is it will not be the normal economy as it was. I mean, we might not be able to go back to the norms. So there might be realignment, which might be needed. And it is uncharted territory, and how we navigate in it is a bit challenging. So with that, I mean, we will have future issues of currency, inflation, and rates. So those will come in 2021, not immediately. I'll just stop there. Yeah.
Right. Dimantha, may I ask you to go next? You'll have to unmute yourself.
Yeah. Looking at the situation, I think I agree with the other two analysts. We are in basically uncharted territory. Now, as First Capital, we are also looking at a number of scenarios that are possible, because you have to admit that the COVID-19 now, as we look at it, we are in it for the long term. But at the start of the situation, we were actually sort of considering whether it can be done and over with pretty quickly, with the curfews and lockdowns coming in pretty quickly. So basically, first scenario was where we were looking at, if I take timelines, basically we were looking at the situation being under control and the normalcy returning by around end of April. However, if you really look at it now, you can see that the curfew or the lockdown that we are conducting have actually failed. Now the number of patients have gone beyond the 800 mark as well. So then we come across to the second scenario, where we are basically looking at sporadic cases coming in at different locations, and you have lockdowns coming in those areas while also having an extended period of curfew. So that more or less looks like the current scenario at the moment. Basically, we are looking at normalcy returning then only around end of June. Obviously, economy may be opened up to a certain extent, but normalcy is likely to more or less return towards end of June or early July. However, we are not ruling out a third scenario, which is basically Sri Lanka going into a second wave or third wave. Why we can't rule it out is we've seen this already happen in places like Singapore, or even take Japan into account. So we've seen after the COVID-19 being under control and the economy being opened up, then there is another spur of new cases coming up. So with that, we are looking at a third scenario, which moves out the normalcy situation out of the second quarter as well. So by the end of September is where we are looking at normalcy returning in there. So I will just take scenario 2. So we are looking at a negative GDP growth, as others mentioned. So we are looking at somewhere in the range of -1% to -0.5%. Obviously, second quarter will be the most hit. If we go into the third scenario, obviously third quarter will also get hit as well. However, at the moment, we are looking at the second quarter being hit. And with that, we are looking at credit growth coming into negative territory. We are looking at -1.5%. So you can see currently there is a significant amount of excess liquidity that is built up mainly with the CBSL holdings, or in other words, you can call it printed money as well, with the bulk of that coming in. So without the demand in the system coming into play, you can see that we will have a lower interest rate environment for a slightly longer period of time. We think until around the end of September quarter, we are likely to see a very low interest rate scenario with not much of demand coming into play.
All right, thank you for that. Thank you for that, Dimantha. Lots of questions about, the impact of this capital market closure or the stock market closure will have on Sri Lanka and its foreign participation in the future. We'll get to that. Next up, Nikita. And we would also like to have a GDP forecast if possible.
Sure. So mine, I am afraid it's not it's not terribly different, except where I've looked at a few multi-layer perceptions of the COVID spread, and according to the covid.iq.lk website, the projections they've done, according to them, the peak of the COVID spread is now it's actually about 2 or 3 days back. So according to their hypothesis, they predict the spread end to be 12th of July 2020 and the final spread total to be less than 1,000. Now this is an extremely optimistic scenario, right? If you take the worst case scenario, even if this number is 3 times this, I think we are far better than all our emerging peers, save for Vietnam, who have done a phenomenally different job in resisting COVID. So in such a scenario, I think we should compare ourselves more with the reactions of the Wuhan city itself, how they contained the spread and opened up the economy at a staggered basis and came back to full operation. So for me, the GDP growth forecast for 2020 in 3 different scenarios ranges from a negative 1.5% to a worst case scenario of 3.5%. Keep in mind that this itself is coming from a pretty low base. We had 2 pretty bad years in 2018 and 2019. So I think I might agree with Chethana's V-shaped recovery because, again, going back to China, one example I could take is they reopened the Shanghai Disneyland. So they sold 24,000 entrance tickets under 3 minutes. Now, this is akin to revenge spending. People who have been in a lockdown scenario are just going out to spend. So this is not a direct comparison by no means, but consumption, it will be interesting to see how discretionary spending would recover. Our spending, on the other hand, is not comparable to China's because we have higher taxes compared to the last 2 years. Now, when the VAT was reinstated in 2016, we've seen the consumption taking a huge hit. And when the taxes were removed in November 2019, last year, we really did not see a jump in consumption akin to a reverse of it. So that means that the proposed injection did not work. So we need to wait until consumer confidence increases, and it'll start gradually, but GDP for and the other thing is we are extremely dependent on 2 things: tourism and remittances, and both of these will be disproportionately hit by COVID-19. Remittances particularly, because 40-45% of our remittances come from the Middle East, which is affected by low oil prices, and the 2 other main contributors to remittances are Italy and South Korea. It couldn't have been a worse situation for remittances, and remittances play a big role in our consumption. And if you look at the last 15 years of our consumption patterns, we've had a 60-65% of GDP coming from consumption alone. So these factors will affect our GDP growth. I think -3% is a likely scenario, and the reduction in GDP, the limited fiscal space, and our need to borrow more going forward. The combination of all 3, I probably feel, would lead to our debt to GDP inching close to 100%. That would be a particularly larger problem given our low revenue base, right? So a lot of these problems that I'm talking about did we did have these problems much before COVID hit us. It's like, if you take an analogy, a lot of badly hit COVID patients had pre-existing conditions. That's us. We had quite a few pre-existing conditions. We've had consistent double deficits, twin deficits, and revenue issues. So while I'm not too quick to compare ourselves with the likes of Vietnam and Taiwan and say the city of Wuhan in itself in other issues, I think the recovery will be clear. And also behavioral economists talk about this concept called suppressed consumption. So we've had our consumption being suppressed for, in 2016 we've had a drought, 2017 we had a large flood, 2018 what happened there, 2019 we had the Easter bombing. So our economy has been held back on a springboard, and this being the longest. So we will have a little bit of pain to go through, but the recovery will be in line with, or could be even faster than, the global recovery. I'm just going by how well we have contained this scenario.
All right. Thank you for that, Nikita. Udeeshan, next up is you. GDP forecast too, right? You'll have to unmute yourself.
So I agree with Nikita on his view in terms of how consumption is going to play a critical role in terms of effective GDP growth. And if you look at our GDP consumption, GDP composition, 70% of GDP comes from consumption. So it plays a fairly large role in terms of our economic activity. And as we look at it right now, we are seeing significant import slowdown, people cutting down on non-essential consumption, just sticking to basic consumption. So it's going to have a big impact on consumption. So, which is why we are trending more towards a negative 1 to 3%. And keep in mind that tourism, which accounted for about 4.3% of our GDP, will come to a complete standstill. So we are looking at somewhere around $1.8 billion raised through tourism this year compared to $3.6 billion last year. This is basically looking at a scenario where even though the COVID situation comes under containment within the next 3 to 6 months, it might take a fairly longer time for the tourism sector to recover. So my view is based on how back in 2003 in Hong Kong, just after the SARS, even after SARS coming under containment, it took roughly about 6 months for tourism to come back on track. So my estimate is based on tourism remaining almost standstill. So we've done about $1.3 billion up to March. We're looking at about total earnings of $1.8 billion until December. So that itself is going to have about a 2.2% impact on GDP. Adding to that, if you look at apparel, which is our largest exports, it accounts for about 6.6% of our GDP. And that now, based on what Jaff is saying, we are looking at about a 30% reduction in terms of apparel exports. So factoring in just apparel and tourism alone, our GDP should contract by 3.7. So if our initial estimate was about 4%, just on tourism and apparel coming down, you will see the GDP falling to 0.3%. Adding to these woes, the government doesn't have much fiscal leeway to spend, given that government revenues have fallen significantly. So there's no investment component coming into the market. And also worker remittances are 8% of our GDP. So that component also kind of contributes towards consumption, because whatever the money sent is spent in the country. So putting all these things together, our base case view is a 1 to 3% GDP decline, assuming that the COVID situation kind of comes under containment within the next 3 to 6 months.
All right. Thank you very much for that. So clearly, we more or less are anticipating GDP to shrink, but there's a big difference, I think, between marginal shrinkage of the GDP to a shrinkage of GDP in excess of 5%, for instance, right? But I'm asking you, to sort of look at that worst case scenario, not because we want to be negative, but it's good to be, I think, for everybody on this webinar, it may be more useful to be prepared for a worst case, so that then it's easier to adjust for a best case scenario, right? So Udeeshan, you put some numbers out there about potentially two of Sri Lanka's or three of Sri Lanka's largest foreign exchange earners, remittances, apparel, and tourism. Right now, these are the three big foreign exchange earners for Sri Lanka. Lots of people depend on them, these three for employment, and the economy depends on them a whole lot. I'll ask the others to weigh in. Can I start with Dimantha? Okay, what is the worst case in the worst case scenario? Can you give us some highlights, some numbers about how sectors of the economy, which sectors may perform poorly and thus contribute to that worst case? Because I mean, in the interest of sort of preparing everybody listening to us to the potential, biggest slip in the economy, right? So that we are prepared for the worst. Can you start, Dimantha? And I'll want to see if others can chime in.
Shamindra, if we are looking at the worst case scenario, as I said, our scenario 3 is our worst case scenario, where we go into a second wave and third wave, and then the recovery starts only towards end of September or early October. So with that, you see that the second quarter and third quarter is significantly impacted. So I said that our second scenario, we were looking at a -1%, but if you go into the third scenario, our numbers come as -4.8%. So what we are looking at, if I were to give you some numbers, so for our base case scenario, basically we were looking at overall exports. If you take goods alone, shrinking by around 35%, and imports also shrinking by around 20 to 25%. So with that, if you take along tourism, we are looking at tourism, as I agree with Udeeshan, we are also looking at somewhat of around 50% reduction, 50 to 55% reduction in overall tourism numbers. So in addition to that, we are also looking at worker remittances significantly reducing. So if you put numbers into play, we're looking at somewhere in the range of a 20% reduction. So overall, that gives a significant reduction in consumption. So obviously, unlike other economies, our economy is not really a trading economy or even a export economy. We are actually a net importer, and that component, the trading component, is pretty small, and consumption is the bigger component that we've already had. So that is where it's going to hit the most, and that's where the reduction in GDP growth is going to come into play. So if we really go into the third wave also, third scenario, where we are looking at a significant disruption in the manufacturing operations. So we are pushing up export reduction to around 45%, and also import reduction comes to around 30%. This is goods alone. And then obviously the services sector, if I take the services exports including tourism altogether into account, so we are looking at somewhere in the range of 20 to 25%. Of course, tourism then moving up to around 60% impact, 60 to 65%. So we've already had a slightly good March quarter, as Udeeshan said. So that is the balancing figure that comes in. So obviously it affects worker remittances, as well. So we are looking at 25% reduction there. So you can see with the third quarter also impacting similar to the second quarter, there's a massive gap in scenario 2 and scenario 3, where it comes down from -1% to actually -4.8 or more closer to -5%. That's how the numbers look, Shan.
Chethana, I'll come to you. Can you try to give us some data, some numbers about how you come up with that worst case GDP scenario? What are the underlying assumptions or factors?
Sure. So just to put that those numbers in context, right? If you look at the key economic sectors like financial services, wholesale and retail, transportation, tourism, real estate construction, and apparel manufacturing, just those few sectors, they account for 51% of the economy, right? And all these, you can arguably, I mean, it's not actually arguably, we know for a fact that all of these sectors are simultaneously being impacted directly by the COVID-19. It's not like these terror attacks, where you have a direct impact to the tourism sector and then a spillover to, say, maybe, the financial sector. And here you're immediately getting impacted by this very, very large scale shock, right? And so that's why we think, and that's why we feel that you cannot have an immediate recovery, right? It has to not, it will be long drawn out. It will be protracted. And when you have that compounding effect, right, that's when you really see these really scary growth figures, negative growth figures that I spoke about. And the problem is that it's not isolated to Sri Lanka. I mean, we all know this. It is a global phenomenon. And if the economies in Europe and US slow down, as they are our biggest exporter of apparel, right? If you take worker remittances, the other panelists have also pointed out, that's our biggest foreign exchange earner. And just to put that number a little bit in context, I read a paper recently that showed that 1 in 11 households in Sri Lanka have someone remitting back money to Sri Lanka, right? So those are the kind of things that, and then if you take the apparel industry, right, it's one of the biggest employers in Sri Lanka, right? So those things tend to impact consumption. And I think it was Nikita or Udeeshan, I'm not sure who, but we know that consumption, domestic consumption, accounts for about 70% of GDP growth. So if you're having that very direct impact to consumption, you can expect the recovery to be far more long drawn out.
Okay, Nikita, your worst case scenario and the assumptions or data points underlying that. You'll have to unmute.
The moment, sorry. So what I can add incrementally is we tend to benefit from the import of crude oil. Now, that's something I forgot to mention earlier. So what we have to take is a net effect. So I believe we'll benefit by about $2.4 to $2.8 billion in 2020 as a cost saving with the reduction of price in oil, crude oil. So still we are looking at a very visible minus when it comes to the reductions we have seen in tourism and remittances. So remittances is a very visible metric of domestic consumption, and domestic consumption probably is the biggest needle mover when it comes to our GDP growth numbers. So that's the chain of actions for me. So we will have a saving from crude oil, but it will be the drop in tourism. My numbers aren't too different from Chethana, so but I think it'll be a little harder for us to get those remittance numbers back into our say 2015, 2016 levels. And the other thing that I was looking at was how quickly our exporters would change. Now, Sri Lanka's speciality is high-end. Yeah, I'm talking about garment exports. Is high-end women's intimates. So, in a post-recession, or some economists even speak of depression, in a recession recovery, high-end intimates may not be exactly the priority of a recovering nation. So, looking at our biggest export bases, that's US and EU. Both regions have been hit disproportionately compared to the rest of the world from this. So, the recovery that we'll see in these would be slower if our garment exporters do not change their product mix. Some already are, and they are going into the production of PPEs, which is timely and which could change the revenue mix. But on this particular segment, a V-shaped recovery is not what we are looking at. But thankfully, when our exports are down, our imports are coming down proportionately. So I'm not looking at the trade deficit to be different. I'm not looking at a trade deficit of anything above 3.5 to 4%. Because as the exports drop, so does the import of intermediate goods and capital goods. And also the amount in terms of crude oil, we've also already seen a slowdown in movement. So we'll see the reduction in our expenditure for crude oil, both in terms of price and in terms of volume. So that would be a saving grace. But my other thoughts are pretty much in consensus.
All right, coming to you, Danushka, while many of you have a worst case Sri Lankan economic contraction of around 3 to 5%, right? The IMF is forecasting the global economy will shrink by more than 3% in 2020, and I mean, I'm also trying to reconcile this thing that Sri Lanka went into this crisis in pretty bad macroeconomic shape, right? Will we do as well as the world economy in recovering from this?
Shamindra, in other words, you are asking me what is our worst case scenario.
Absolutely.
Right? Yeah. So we were fiscally we were in pretty bad shape relatively. So that was a challenge, right? And I'll just be clear. When I earlier said there is a possibility of a V-shaped or U-shaped recovery, provided a global vaccine is made available, I was referring to the global economy, right? And then we might not, as a country, we might not be in the same bandwagon because of our inherent problems now, what you are asking me, right? So yes, it's definitely, even in the event of a recovery, we are going to see a slow recovery, a prolonged recovery, right? It will not be a sharp U-turn or V-shaped recovery for us. Then coming back, I think we have to look at the broad economy and the ground level. Tourism was the newcomer to providing money or income to the country, but I think what was our mainstay was the remittances that supports the rural economies. So I think Chethana mentioned the figure of 1 in 11 households gets remittances. So yes, now we can understand that is going to be affected. We are expecting it to come down by half, right? So that remittances, which were accounting for around 7.5 to 7.6% of GDP, will be halved. I mean, and in tourism, we were generating somewhere around 4 to 4.5% of GDP from tourism income, right? But we can't just take the tourist numbers, because overall there is a trickle down effect on tourism income. So it has really benefited the broad economy. But the problem is we don't expect new arrivals for the balance year, unless a vaccine or proper solution to this health crisis addressed. So we have to just think rationally. So tourism income we expect to be down by around 76% compared to last year, right? So those two figures in perspective. Then comes the other concerns, right? In the domestic economy, the daily wage earners are affected. Right? Even if the curfew is lifted and economic activity is encouraged, the scare, people will be worried. So because of that, the daily wage earners are going to be affected, right? So that impacts from agriculture to construction to the broad economy, right? Various other services. Then also what happens is, okay, there is the concern of job losses. We have already experienced salary reductions, right, from in the private sector. So all these will add together and create a snowballing effect in disrupting demand, this domestic demand. So we are still a service-led economy, right? The contribution to GDP varies from around 67% to 72% in the service sector, but that will be seriously affected. What we see right now is out of the economic sectors or segments which are contributing to the GDP, only agriculture will see a marginal growth. All other sectors will be impacted, right? Manufacturing. And if we are going to the trade account, the issue is around 47 to 48% of our exports are coming from apparel. Out of apparel, around 54% comes from the European Union. The balance, bulk of it is from the US and very marginal percentage from the Far East. That's the composition of the apparel exports, right? So Italy was a big market within the European Union. UK was a big market, right? I mean, we have to be realistic. Those markets are not going to recover overnight, right? And we were supplying them high-end apparel. Right? Apart from few chains in UK and Europe, we were supplying the low-end apparel chains. But other than that, it was more of a value-added sort of service which we were providing. So that demand component, we have to expect that it will not be there in the short run, unless a recovery comes about. So, and practically speaking, it's not very easy to transfer or shift from your normal production lines to PPE equipment or PPE garments or whatever you call it, personal protection equipment. It's not very easy. We need to source the material. We are not manufacturing the fabric or the required polymer-based, plastic-based PPE material in Sri Lanka. We have to source it from somewhere. Is it going to come from China? The supply chain is changes, and not only us. So in the apparel sector, we had built up a brand as producing high-end apparel to the world. Now, again, the playing field has opened up. Anyone can start manufacturing PPE stuff. So it's open, and the margins are not that significant. So it's challenging. You know.
Let me get into a quick fire round of questions. These are quick fire, right? And work with your worst case scenario, because I think this is the scenario that we want everybody to sort of be prepared for, if at all, right? And I'll be the devil's advocate here, right? And suggest that GDP. The first quick fire is: what are the chances of GDP contraction greater than 5%? Right? 1 to 100%. What are the chances of a greater than 5% GDP contraction? I'll start with you, Chethana. Just give us a number, percentage. What are the chances of a greater than 5% GDP contraction? Worst case.
That's a mean question. It's really hard. I mean, honestly, probabilities, but okay, I would say maybe 25. Worst case, okay? So this is like anything over like 5, like anything over negative 5 to 6. So in that very worst case, I would say maybe
25% chance.
yeah.
Dimantha?
Because we have those inherited problems also.
Yeah. So basically, I'm also looking at somewhere there, but I would say in the range of 20%.
Danushka?
As it stands, right, things could change, right? It's very fluid. As it stands, it's around 20 to 25%.
Nikita? Mike?
Okay, sorry again. Well, looking at what a low base we had in 2019, I'd say it's 10%. Just the base case, nothing else.
Right. Udeeshan?
I would go with 25% on this.
Right. Okay. Again, worst case scenario, exchange rate by year end. Chethana, I'll start with you.
I'm expecting Shamindra another 5 to 6% drop, and I'll really quickly tell you why. Because if you look at, I mean, everyone has referred to this before about work remittances, apparel, all of those, right? But if we actually do some of the maths and in line with some of those expectations that they are talking also, if you look at our three main export earners, that is remittances, apparel, and tourism, we think that we could lose about 4 billion, right? Now that is somewhat offset by about 2 billion savings in the oil bill, right? We have also secured funding of about 2 billion so far, right? Through the RBI, through China Development Bank, all of that. We still have a debt repayment of about 4 to 4.5 billion, right? So if you do the maths there, you know that we're looking at a balance of payment deficit. Yes, to some extent, the oil savings and the funding lines that we've secured so far is helping it a little bit, but there is still a bit of pressure, and therefore I do believe that we will experience another 5 to 6%.
Right. Remind us how much it's depreciated by, the exchange rate has depreciated
right
so far? Yeah?
It's about 6, I think.
It's about 6. So we are looking at maybe 10, 12% depreciation this year. Dimantha?
Yeah.
Quick fire.
So basically, yeah, so earlier before COVID, we were looking at 188 to 190. Now we've actually downgraded it to 200 to give you a range. 198 to 203 is our range, mainly looking at the our foreign reserves target for towards the end of the year, and also the debt profile or the repayment ability.
Danushka, you're next. Worst case scenario, what is the exchange rate year end?
Taking a bit of a different viewpoint, because our trade deficit, I think, will in absolute terms contract, right? So we expect the trade deficit in absolute terms to hit only around 5.5 billion, right? Down from around 8.7 levels, right? So few reasons. Oil saving, right? Even though lesser exports, bulk of the exports are derived from imports, so that balances off. Then there is a sort of like a short-term embargo on imports, luxury items or stuff, so that also will assist. And also, even though we are a import dependent country, with demand destructions happening locally, there is not much demand on the imported stuff, so that sort of will balance out, and in absolute terms we will be better off. But we are more focused on Sri Lanka's debt position, the ability to repay ISPs and honoring our debt servicing commitment. I believe that is in line of happening. Yes, our reserves are coming down. It has come down by around 300 million, right? Down to around 7.2 billion, if I'm not mistaken. So, but this is not common. I mean, this is happening globally. And what is happening is US is also printing money. US is printing money, that sort of basically balances out to a certain extent. So our currency, I don't think is going to be at significant pressure, right? Compared to what it was earlier.
Okay, well, give us a number, Danushka, if you can.
It won't, we are expecting somewhere around 198 to 200.
198 to 200. Nikita, for you, what's that number?
worst would be 205 because been mentioned. What I can add here is our facilities with the CDB, 800 million from IMF over the next 2 years, swap of another 1.5 billion with the People's Bank of China. So I think 2020 we have a bit of a peak in repayments. I think it's about 4.8 billion, but for the next 4 years we have an average of 4 billion a piece in terms of repayment, and that's manageable without. And our interest rate is sensitive to is not trade, rather than trade flows, more investment flows. And the fact that we've had a lot of them going out in 2018, and the fact that foreign holdings in our bonds is less than 0.5%. It's not, our exchange rate is not really in danger. So yeah, worst case 205.
Okay, Udeeshan, very quickly, what's your forecast?
So our forecast is around 200, 205 worst case. I take the view of Danushka in terms of there will be an improvement on the trade deficit front because imports, there will be a substantial reduction. We can take the 2009 scenario so as a replica of what has happened. In 2009 also, the trade deficit actually contracted. In addition to it, if you look at the last 2 years, the larger part of the depreciation was driven by the capital outflows. We saw about 80 billion outflows last year. And the previous year was another 100 billion. But as of now, there's only 23 billion rupees in the bond market, which is not a significant amount. Plus, I think we might be able to manage our debt repayments with the lining of the foreign loans, multilateral and bilateral loans that we have planned up to now. So I think we're in a comfortable position. The only thing that makes my forecast between 200 to 205 is the level of money printing which is going on. Apart from that, I'm more comfortable in terms of a sustained rupee at current levels.
Okay, so I will indulge you just one sentence answer on this one. What's the interest rate at year end, do you think? Can I start with Chethana?
We expect it to come down, Shamindra. So maybe, yeah, I don't have an actual number, but we expect the general direction to be down.
1 year T-bills are now what, 6.5-ish?
Yeah, so maybe 4.55.
4.55. Dimantha?
Yeah, so basically we are also expecting a low interest rate environment. However, towards the end, we are looking at T-bills to only be in the range of 7 to 7.5 for the 1 year. And for the 5 year, we are looking at sort of 8.5 to 9.5 range. Now that basically gives out the target for the AWPR, basically the banking rates which go broadly in line with the bond rates. So basically we are expecting a significant reduction in AWPLR. We are looking at AWPLR towards the end of the year or towards the end of the third quarter coming down below 8.5% as well because of the lack of demand for credit, and then probably towards the last quarter hovering in the range of 8.5 to 9%.
No, hang on. So what is the prime lending rate right now? AWPLR.
Currently, I think it's around 9.3. No.
Oh, so you are only forecasting a marginal drop there, right? Yeah.
Yes.
In fact, you are thinking that interest rates will go up from. Interest rates have to go up from where they are right now, not AWPLR, but the 1 year T-bill.
1 year T-bill, yes. 1 year T-bill, I think it's a bit too low at the moment. So 1 year, I think, is going at around 6.5, isn't it?
6.5, yeah.
Somewhere around there.
Danushka, I'll come to you. What do you think? Interest rates year end?
No, I think it's 7.5. The 1 year T-bill going at the moment.
7.5. Okay. Can somebody Google that up, please?
I think it's capped at 7.
7. Okay.
Yeah. I think the option is capped at 7. Yes.
Okay. Right. Danushka.
So we expect something like only around 50 to 75 basis points dip in the 12-month rate. So If the T-bill is right now at around 7%, we are talking about something like 6.25 to 6.3% levels, right? For 2028. It could change in 2021 for sure.
Nikita.
I'm expecting a downward shift in the entire yield curve, say by about 85 to 100 bips. Liquidity is the only concern here. Too much of it.
85 to 100 basis points. 100 basis points is 1%. Just so that everybody gets it. Yeah. Udeeshan.
Yeah.
50 basis points reduction in the T-bill rates. Basically, it's because of your liquidity situation. So now.
Okay, so again, coming back to a question, right? We've had a massive outflow from the bond market. You mentioned, and several of you mentioned, that the outstanding bonds, bills and bonds owned by foreign investors is just north of 20 billion rupees, which is down from about 140 billion, right? But this hasn't happened in the stock market, because the stock market's been closed for 1.5 months now, right? I mean, this is the top question out there. There are people. I mean, the top question out there is how has this move to close the stock market been a wise one for so long, right? Before we weigh in on this, can you talk to us, now we're talking equities, can you talk to us about what you anticipate will happen with foreign holdings? What are they like in the stock market, and what is likely to happen? Chethana, I'll come to you.
Shamindra, is the question what the overall stock market will drop, or what
No, I'm asking particularly about foreign ownership of shares in the stock market and what will happen, because the foreigners have moved out en masse out of the bond market in the last 3 months.
Correct. Yeah, exactly. And so that kind of gives us an indication, Shamindra. We do know also that on the ISB spreads, the risk spreads have increased by about 1,600 basis points, which is a really stress point, right? So we know that for the safe assets like sovereign bonds and government securities, the outflows have been strong, right? So definitely, I think we can expect, the worst outflow that the Sri Lankan stock market has had in billion rupee terms was about 38 billion, and that was sometime in 2012, 13. As the economy was sort of overheating, foreigners started to exit. So that is the highest that we've had on record, right? So I think, it's possible that we are, it's already, and also you have to remember that they have been selling out for the past 2 years, like pretty much since the beginning of 2017, they've been exiting the markets, right? So I think, something like in the 30 to 40 billion is a possibility, especially because, we've been closed for so long also. They might get scared by the liquidity concerns and stuff like that and want to exit faster.
Nikita, I'll come to you, because we were having this conversation before, right? And a couple of days ago, I think, and you talked about how much foreign holding there is in the market. Was it? I think it was with you that I was having this conversation.
Yes. So right now, more than the absolute amount of foreign holding, I think it's their mindset. Right now, if you look at the moment the stock exchanges all over closed, there was and opened. This would have been in the 2nd or 3rd week of March. There was a run for cover. There was a run for liquidity all over. It wasn't going into even any other asset class. It was just staying in liquid cash, textbook cookie jar liquidity. This, however, over time, over the next 2-3 weeks, investors looked at the prevailing prices, looked at demand and supply, the possible liquidations that the funds had to go through, and now investors are finding their feet. And if you look at our regional peers, some dropped as much as 60-65% only to recover about 35-40% afterwards. Markets like Seoul, Tokyo, Vietnam. So if we look at all our emerging peers, the net impact year to date would be about minus 20%, right? Sri Lanka, on the other hand, year to date lost 27% before the markets closed on the 18th of March. So we've actually fallen a lot far before the markets closed compared to the net amount. So there are two ways of looking at it. Either we need to think that we've fallen too far before, or we can use our emerging peers as a guidance to what the post-COVID sell-offs or equilibrium could really be. Also, I don't expect the foreigners to be very thrilled about the fact that we kept the markets closed for 7 weeks. It closes the entire idea of having a market. But then it's happened. And if you look at post-Arab Spring Egypt, if that is any indication, now that's somewhere we saw the Egypt stock market close for 3 months. And it was almost at the danger of being pushed out of the MSCI index. So having the market closed and the investors exiting in March in 2011, the foreign institutional investors are also rather forgiving, because in 2016, the Egypt market became the best performing market in the world. So as long as you keep correcting your mistakes, and as long as you, more than anything, as long as you deliver, the investors are forgiving and they'll come back. But the thing is, you need to deliver and you need to maintain the concept of a market.
Yeah,
So
what I'm trying to also find out at this point, guys, is the impact on the rupee of the foreign investment in bonds is now almost over, because foreigners have exited most of their holdings, right? This has not happened in the stock market. It has happened to some degree. Chethana said so already, right? But what is that? How much money is still invested? Foreign money is invested approximately, right? If you ignore those strategic stakes, that Nestle is largely owned by its foreign parent, that British American Tobacco is owned by its foreign parent. If you ignore those, but how much money is at stake here, and what is the likely impact of that outflow on the rupee? Udeeshan.
Shamindra, if I were to answer that question, so the foreign holding in the market right now, excluding strategic holding, is about 267 billion. So it's 12 times greater than what's there in the bond market right now. 267 billion. If you add the strategic stakes in terms of CTC and whatever, you look at about 450 billion-ish in terms of total foreign holding. The only thing is that the market is not liquid as the bond market. So even though there might be appetite to sell, they might not be able to sell. So I really don't see huge selling coming in. But in terms of what we are seeing from the funds that we are dealing with, in terms of emerging and frontier market funds, what we are clearly saying is that their fund sizes have significantly shrunk during the last 6 to 12 months. And that is because of there has been a shift from emerging and frontier to developed market kind of shift that has happened as well. So it's not only the case of Sri Lanka right now, it has been the case for the other frontier markets as well. But my feeling is that given that the foreigners are a little bit more worried on our fiscal conditions, the market closure, they might take a little bit more time to come in when things start turning around. So normally you'll see the shift in terms of foreigners coming back into emerging and frontier market funds when you see the recovery cycle starting to happen. So for the next 6 months or so, we are not seeing that happening anytime soon. And then thereafter coming to Sri Lanka might take even longer, given that we are not in their first screen as such because of our debt position, our fiscal position, and the regulatory environment as such.
So there's almost $1.5 billion in foreign investments that can potentially have to be shifted out, because these are holdings of mutual funds potentially, right, or long-term savings of foreign citizens elsewhere. And when they want to shift from emerging or frontier to a safer bet, they have to sell. Right. Okay. I'm going to sort of try to ask you, what is the likelihood that half or more of this, $1 billion, let's say, of this would shift out in this year?
So if I take that up, Shamindra, I'm not sure that kind of money, whether for one thing, whether as Udeeshan said, can be shifted out because of the selling problem. See, our market is not as liquid as some of the other markets. So most the liquid stocks are as much as you could say about 20-25 stocks that are in the market. So it's difficult to say that $1 billion can shift out of the country in a matter of 6 months, because if you take the current scenario, I don't think that there is not going to be a lot of buyers in the market. So there's going to be a lot of panic selling from the locals as well, not only the foreigners, but foreigners will also be desperate to sell, because we've actually kept the market closed, because one of the most liquid asset classes in Sri Lanka has become non-liquid because of the closure of the market. So it's so sometimes we call the money in the stock market and the bond market as hot money, where you quickly put in and quickly take out. But so when you take out that component, it's a big negative for the foreigners. So there are, as far as I know, there's only a couple of stock markets closed in this region. I think it's the Sri Lankan market and the Bangladesh market. So comparative to the region, then we fall far back in their next selection of where do we go to sort of case. So basically, rule number one, definitely they will look at selling as much as possible and taking the money out. So yes, basically year to date, the market has come down by around 25% or so. But we feel there is basically, I'm looking at scenario 2 where things normalize by around June and so on. So basically, in such a situation, we feel that there is a further 15 to 20% reduction possible in the market. So we are looking at somewhere in the range of 3,750. However, it could fall lower if we go into that worst case scenario. Okay. So at the moment, we are looking at 3,750, and of course, a slight rebound, basically to around 4,750 towards the end of the year. So we are not looking at, even after that, we are not looking at larger growth rates in the market because of the macro situation. So as I said, the deteriorating foreign reserves position and the debt position towards the end of the year is going to have make things worse in the following year for 2021. Remember, we are still even in the global sense, we are still going into a recession. So we are still clogged in this health situation, but we've not really, the numbers are not out as yet regarding the recession. So in the coming quarters, we will be going into a recession where we will have a significant impact as well. So with that, we will have a week next year as well.
Will any of you be bold enough to suggest by now Dimantha's already given, I mean, several of you have given us what you anticipate will be the market's performance this year in terms of by how much more will it shrink, right? But can I just go do a quick round to see what that worst case is? Dimantha, you're suggesting another how much?
I'm looking at another 15 to 20% in a base case scenario. But if you are looking at worst case scenario, we can go up to around 25 to 30%.
So overall prices would have halved this year, market would have fallen by
so
half.
Basically, we are looking at negative 5% GDP growth. So with that, definitely we're going to go.
Danushka, can I ask you?
Shamindra, you're asking me the worst case scenario for the market, is it?
Yeah, worst case scenario for the market. We're down about 20 plus right now. What do you think will happen for the rest?
Maybe another, as Dimantha said, we also agree with something like another 10 to 15%. But there is a flip side. The foreigners foreigners actually might return if after we repay our ISP. The biggest concern for the foreigners is Sri Lanka going into debt default, nothing else. And also, I have to tell you here, we closed our markets on 20th March. The entire frontier market space also shown some sort of a parallel movement. The frontier market index has come down by around 21%, right? Sri Lanka came down by almost like 28%, right? Ahead more than the frontier market index. But what has happened is we had closed our market at the sort of worst point. We are seeing this in hindsight. Now we have the luxury of going back and seeing it. Thereafter, from 20th March onwards, all the markets, all frontier markets and some of the emerging markets have gained. The frontier index had gained around somewhere around 7%. So because we were closed, we haven't seen that gain. So yes, there is some sort of pent up selling pressure from the foreign side, which could not be materialized due to the market closure, which might come in the next few weeks. But after that, the biggest concern is Sri Lanka's debt default. So if that is paid out, even though the market might come down, maybe in the worst case scenario, maybe around 10 to 15% from this point onwards, there is the possibility of a quick bounce back and stability for some time.
Nikita, the base case scenario seems to suggest that the market will shrink 50% this year, the base case, at least for Danushka and Dimantha, approximately, right? What is it for you?
Well, seeing that we've already shrunk by 27% and looking at the net that our emerging peers, who on the other hand have far better comparable balance sheets, have done about 20% for the year. It would be fair to factor in about 10%, but then again, this is just me throwing numbers into numbers out. There's really no calculating for panic, and there could be a bit of that coming. And depending on what the funds are being told by their principals, sometimes they make decisions with regard to whole regions. And if they insist on leaving a particular region, then and also we are a much smaller portion of the whole pie when it comes to moving the needle in a fund performance. So it's really
got it. So again, reminder to everybody listening out there: none of these guys, to the best of my knowledge, have a crystal ball. So they are treading on thin ice here. With that caveat, Chethana, what do you think is the base case and the worst case?
So I think, so if you just look at the numbers from the time that the pandemic really sort of became a pandemic to the time that the market closed on the 20th of March, we dropped about 22%, right? And if you look at most economies, big and small, on average at the trough, they have dropped about 30%. They may have subsequently recovered, but at the trough, it's 30%. So I think at minimum, we have another 10 to, I'm on board with these guys, there's another minimum, at least another 10% to go once we open. Now, the reason why I say that's a minimum is because if you look at the worst drop in Sri Lanka, in the history of the Sri Lankan equity market, it was 41% for the full year, 41% back in 2008 after the global financial crisis. And I mean, I think we've all agreed that this is far worse than the global financial crisis. So that's why I say the 10% drop would be a minimum. There is a lot of space for there to be a much more substantial drop for this year.
Okay, so that's horrifying context, right? Udeeshan, the worst drop we've had coming off, an unanticipated event, more or less, was the global financial crisis, 2008, 41%. This is a far bigger crisis.
I think most of it is already adjusted, but I strongly feel that there will be panic selling when the market opens. So markets will overreact to the negative event. So based on that, I initially see a 10 to 15% reduction. But I agree with Danushka on a possible rebound towards September, October, when the ISB is coming due. And keep in mind that markets and the economy don't move parallel. So if the expectation is you're seeing a revival cycle starting to happen towards mid next year, the market probably will start rallying towards the second half of this year, or at least towards the fourth quarter of this year. So my base case would be, my worst case would be the market falling to about 3,800, and then probably a recovery to about 4,500 by the end of the year.
Okay, I don't. If I give you the enviable task of trying to giving you some money right now and suggesting, here's 50 million or 100 million, right? Once the market is opened and this 10% decline has happened, the sort of base case decline that you're looking at, where do you think that money can be put to? Is it wise to look at stocks? Blood on the street. That's where our title comes from. There's blood on the street. Seasoned people will tell you that this is the time to be picking assets, right? You have 50 million. Will you be looking at the equity market? Dimantha, you're nodding your head, so I'll come to you. Blood on the street.
Yeah, so definitely with the decline in the market, obviously you should be buying into the market. So basically what I would be looking at is, so if we look at the stuff that can quickly recover after this situation is the food and beverage sector, the telco sector, the healthcare sector are some of the sectors. So my favorite would be to go into the food and beverage sector. I think even in a drive where consumption starts from bottom and starts recovering gradually, food and beverage would be the first to recover. Then you go into the white goods, then the vehicles and the real estate. So food and beverage is key. And then I would like to pick a slightly longer term few stocks, which is the banking sector. Obviously, it will take about 9 to 12 months for this sector to bottom out and recover. So because in terms of earnings, because this year is going to be full of blood in terms of earnings, because so it will slightly delay with the debt moratoriums that are coming in, but once that finishes off towards the December quarter, you will see a lot of negative or high levels of impairment coming in if they don't provide it before. So my second bet is to go into the banking sector when the earnings are negative. Go into the bigger banks which has the cash, which can weather this impact. We've seen over the years the larger banks performing better after this kind of period. So Commercial, Sampath, H&B are some of the stocks I would pick in those sectors.
A couple of quick questions. What was earnings growth, just to give everybody on this call an idea, what was earnings growth like last year, financial year or calendar year, if you can give us a number?
Yeah. So basically, we are looking at a downward trend in earnings over the last couple of years. So 2018 has overall market earnings has declined by 12%, and 2019 13%, and this year we are looking at a 26% reduction in earnings. So this is the first time in 2 decades that we are seeing earnings drop 3 consecutive years in a trot. So that's one of the reasons why we are looking at a significant dip in the market.
So cumulatively, earnings, or what we mean by earnings is profits in the market, would have halved in 3 years by the end of this year. Approximately.
I'll just get the numbers. Yes. So basically, overall market was peaked closer to 300 billion, has come down to around, is likely to come down to around 166 billion this year. Yes, correct.
Wow, okay. Danushka, what's your earnings forecast for this year?
We are expecting the broad market earnings to come down by around 30 to 32%.
Okay, and you have 50 million rupees. Are you willing to take a wade in once the once the market has come off 10%, or rough approximately? Yes, I want to.
You're asking me, okay.
Yeah.
Shamindra, yes, but the thing is, we have to wait for the price discovery point, because markets have been closed. We need to see through the first week and see the price discovery points. We are at this moment, we can say, okay, these sectors looks attractive, but to collect or accumulate in a measured way. But the entire picture might change once the market starts trading. So we need to wait for that moment.
Okay, so you're bringing up that important point. I'll come to the others with the same question, but you're bringing up that important point about the market is a tool for price discovery, nothing else, right? And we've made that an impossible task to achieve because the market has been closed for 7 weeks, right? On a scale of 1 to 10, how bad an outcome was that? Like, let's assume that some level of closure was inevitable, right? But 7 weeks, on a scale of 1 to 10, 1 being, this is okay, 10 being this is a terrible outcome. How bad was this 7 week long closure? Assume a 2 week or 3 week closure was maybe inevitable.
Shamindra, I don't think I'm qualified to put a scale to that. You know why? Right? Yes, markets needs to be open. That's the fundamental theory behind it for liquidity. But we were facing an unprecedented situation, and there was apparently requests from the industry to keep the market closed to contain the health crisis. So yes, it was not good to keep the market closed. And at the initial stages, we had a lot of inquiries from the foreign clients who were very disappointed about it. I'll be frank with you, right? So yes, but thereafter, the foreigners also did not realize the gravity of the pandemic. After 20th, around April only, they also started realizing the gravity of it. So then situation changed. So if they were really upset on 20th March by Sri Lankan stock market being closed, I don't think that still sort of lingers in the back of their head, saying, okay, this is a liquid market, etc., etc. But yes, it would have been good if we had not kept it closed for this long.
Okay, tactfully navigated. Anybody else wants to weigh in on that before we get to the other question?
I would like to comment on that. Basically, I would say 10 out of 10, it was one of the worst decisions that could have come because it goes
Dimantha, we are losing you. I will shift to somebody else and come back to you.
The fund and have the bond market. Okay. Can you hear me now?
Okay, that's better. Okay, you'll have to start again. It's 10 out of 10 worst thing we could have done. That's what we heard.
Oh yeah. So basically, mainly because if you can have the bond market open, if you can have the debt market open, definitely we can have the stock market open also. And you can see there's so many examples around the region itself. You don't have to go far away in the region as well where the market is open. So I think in terms of liquidity, it goes against the fundamentals of having a stock market by having the market closed. So I think it was one of the worst decisions that could have come.
Udeeshan, Chethana?
Yes, I think the market closure was a bad thing overall. Yes, there were some health concerns and the curfew concerns initially, but stock market investment is similar to any other kind of investment. So, for example, how would you have felt if you went to a bank and asked for deposits? Your deposit was maturing, and you ask for your deposits back, and they don't pay you, or say its bank is closed. So that's a kind of feeling the foreigner will have. For Sri Lankans, it's a very small component. Stock market investment is a very small component, which is understandable, which is But from a foreigner's perspective, it's completely different, which is what I believe.
Chethana?
Yeah, I'm going to agree with Danushka and Udeeshan. Like, I agree with Danushka in that, you know, it's a very thin line to balance that public health crisis and the economic fallout, right? So it's a tough decision for all governments, and I think so. I appreciate what his point is. I also agree with Udeeshan that I think the people who the market closure affects the most is probably, like he says, the foreigners as opposed to the local investors. So I agree with Udeeshan and Danushka.
Okay, since you're talking already, are you willing to wade into the market? Once the initial dust is settled, once that maybe that 10% correction you guys have been talking about is forthcoming. Are there sectors you think that are worthwhile looking at?
Yeah, the short answer to your question is, if I had a long-term horizon and I did not have any immediate liquidity needs and I had a long-term horizon, then yes, I would definitely get into the market. Because I think, the valuations that come after the drop are probably going to be very attractive entry points for investors who can, add equity into their portfolio. And the sort of sectors that I would look at that stage would be two types of sectors. First is those sectors that are defensive, so those sectors that can weather the storm, so to speak. So, for example, things like telco, healthcare, we know that those are sort of defensive stocks and where consumer demand is sticky. So I would put some money into that because those are the ones that will be able to weather the storm in the short to medium term, And then, of course, I would, at a longer term horizon, I would begin to look at things like banks and diversifieds, because if we look at historically which sectors have tended to recover the fastest after a crisis, it has been the banks and the diversified, and particularly banks. So I think if you have a long-term horizon and you don't have any immediate liquidity needs, and you need to build an equity long-term portfolio, then yeah, I do think that these entry points would be attractive.
Nikita, I'll put the same question to you. How appalling a decision was it to close the market for this long? Was it? And what would you do with, if you had that money, what would you be doing right now?
Okay, question number 1, 10, 11. See, the thing is, Sri Lankans have anyway a steeper equity risk premium to the other emerging frontier markets because of our size, because of some of the governance issues we've had, and transparency. We're a frontier market, so we have a visible ERP, and with what happened with the closure of the market, the equity risk premium that the foreigners used to pay for our stocks just increased. 2, if you're giving me 50 million and if you actually have a gun to my head right now, well, yes, but not on the first day, because I think the consensus here is that there will be a sellout. Most foreigners would be looking at a safe space. But I believe what I could add incrementally to what's already discussed is telco, Dialogue in particular. I think Dialogue is the stock that's closest to what we can call a stay-at-home stock. It's the closest to what we have for Netflix. With all that we are doing with the whole social distancing, the physical distancing, the work from home concepts, I think we continue to make them a lot more money. So there are caveats. There is the Forex exposure. There is the fact that we pay less per used gigabyte of data. That does happen. But the thing is, if you take their cooperation into focus, that is the closest we have to a safe bet in the CSC right now. Then I would go into modern trade. I would have a bias towards modern trade that have linked or evolved their business very quickly and had access to last mile delivery. I'm looking at stocks like CCS, CCS and Cargill's in particular. Consumer discretionary. There's a huge step over discretionary, over non-discretionary here, because the priorities obviously are going to be very different in a recovery mode. Healthcare is a safe bet to be on. Good cash cow, and right now it doesn't have anything to do with the COVID-19 in itself, the private listed healthcare, but with the government sector, which is the biggest competitor to private sector healthcare providers right now, being stressed, I think the private healthcare would be a good destination for smart money. And smaller scale exporters like HACAB and dipped products, who actually have more to gain from the pandemic than losing.
Which companies are you most worried about? I mean, I'm sure you're not looking at all 280 companies, but you must be having a good view of a few dozen of them, right? Which ones are you worried?
Obviously, the companies that are exposed to tourism.
Right.
Tourism, obviously, that's an obvious takeout. Consumption in the higher end. High-end consumption, I believe, will take a much longer time to recover from the non-discretionary ones. I would be also concerned about companies that have higher levels of debt. So right now, cash would be king. So companies with solid cash flow and a good cash balance, I would be more favorable of. I'm very positive about companies like lubricants, where their raw material cost of goods sold is considerably lower year on year, and their cash needs are low, but the cash balances are very healthy. So they may sell much lower in terms of units, but it's a safe bet.
Okay. I'm trying to sort of dissect this market into pieces that, where we can have a sort of discussion that's easy to understand, right? About 40% of our stock market is accounted for by the banks, approximately.
Yes, correct.
Yeah.
Okay, and you add John CALs into that, and that's half the market, right? You add Ceylon Tobacco into that, that's 60% of the market. I think something like that. Okay, maybe 55.
If you're looking at the total market cap or the free float. If it's the free float, then people like Nestle and CTC may not have a...
Yeah. It doesn't make sense to talk too much about CTC or Nestle for that matter, right? Let's talk a little bit about banking and also John CALs. Now, can perhaps I ask Udeeshan to come in? What's the outlook like, Udeeshan? If it's do you have a strong view about banking as a sector, and particularly about also John CALs? I think John CALs is 50% of its revenue approximately came from tourism.
It's actually less than that. I'll start off with the banking side.
Sure.
So it's not going to be a great year for banks in terms of earnings. A couple of reasons. So starting from loan book growth, it's going to be very subdued. I don't think it's going to be negative loan book growth because there is a moratorium component which is coming. So there's no maturities, or 35 or 40% of your book is not maturing. And there will be a slight take up of working capital loans. So you're looking at about probably a 2 to 4% kind of loan growth. On the margin side, rates coming down are anyways bad for banks because they have very large current account and savings account, which doesn't reprice. Second is that the debt moratorium, which has been talked about right now, but the proposal which has come in is that the interest component has to be borne by the banks. So if that happened, there will be a significant hit on the interest income line. Plus, we've seen reduction in terms of bonding interest rates being slashed, credit card rates coming down, and the central bank keeps saying that rates should be cut down further. Working capital loan at 4%, the margins are going to be very thin on it. So overall, we are expecting the net interest income to not grow much. On the fee income, you are looking at trade, which is a large part of their income, which is imports and exports, is going to fall by probably 50% or so. And on the other hand, we are looking at impairments, even though it's not recognized technically. Central bank has given 2 months in terms of extending the recognition. There will be a huge pile of impairments which will come in the next couple of months. So overall, banking sector earnings is not going to look that great. It might be one-off, it might be for 1 or 2 years or 1.5 years. But I strongly believe, given that the big banks are trading at 0.4 times book or 40% of the asset value, there is strong value in the banks right now, especially the ones which are very well capitalized and they have very very strong balance sheets. My views on John CAL's Ceylon Cold Stores consumer, which is a larger part of their business, about 30%, will definitely bounce back. And I think they've caught a bit out market share in the current context. Overall, I believe that that component will start picking up. There has been not much of an impact on the transportation side as of yet. We've seen a 20% decline in transshipments. Once the Indian ports start opening, we might see that bouncing back. The bigger question for me is tourism, which is roughly about 20% of revenue. It has come down significantly compared to where it was before. So that is going to be almost like zero kind of revenue for the next couple of months. And the bigger part of the equation is cinema and life. Given that your investment of $800 to $900 million have gone in, the apartment sales are still at 65%. For me, the recovery time for cinema and life will be far greater. And keep in mind that majority of the debt will be taken, or the bank loans will be utilized in the next couple of months because the project is in its latter phase. So your interest income is going to start coming down. So from an earnings perspective, JKH is definitely not going to look that great. Yes, there is value from a long-term perspective if these projects work through and when cinema and life actually starts materializing value. But for the next 1 to 2 years, from an earnings perspective, I'm not that much.
Anybody else wants to weigh in on banking? So we are a little over time, guys. What I'd like to do in the next 10 minutes is also to see how we can sort of wrap it up. I want to talk multi-asset classes as we wrap up, right? We've just, if you had money and access to all these asset classes, what would you do? Would you rather keep it in cash also? But talking about banks, Dimantha, Chethana, Danushka, you want to weigh in?
Yes, basically, as I said earlier, I think also the bigger banks are what we favor. So can you hear me?
Yes, now yes.
Yeah, so commercial HNB and Sampath are our favorites. Also, as I said, telcos who are actually benefiting from higher streaming these days. So it's likely to recover fast as well. So we are very positive on the telco sector as well. And yes, I also forgot to mention, I agree with Udeeshan. The retailing, food and beverage retailing arms, basically things like CCS, even car gears. We are very positive on those companies because they are likely to be the fastest to recover. If I may touch a bit on the sectors that we are not at all positive on, basically construction and real estate and tourism are three of the sectors which we think will take more than 12 to 18 period to basically recover in the consumer demand cycle. Real estate or housing market will open up at the probably end of the consumer demand cycle. So with that, we think it will take a longer time for the real estate market to really start picking up. So because of that, even though banking may take a slightly longer time, like 9 to 12 months, there's a significant decline in banking stocks. And the larger banks are where you can benefit from because they have a lot of cash and a lot of capital at this moment of time. So yeah.
Okay, this next round of comments is likely to be the last round we are doing, right? I will start with the three of you who are principally looking at equity only, and then get to Dimantha and then Udeeshan in that order, right? I'll start with Chethana, but I'm also now, that proverbial gun was on your head, as Nikita said, when I gave you 50 million and said, okay, now I'll try to see if you can invest this, right? Now you have 50 million, but an option exists that you stay in cash, or let's say you have a realistic option of converting your investments into cash, right? What's the approach? These are your last set of comments. How do you work between the asset classes? Is cash the best thing to be in? When I say cash, it can be a very short-term instrument also, right? Obviously, we keep it in a very liquid short-term instrument, which is very low yielding, but that is what I mean by cash. If you had, if you now had no pressure, what would you do with your portfolio for the rest of the year?
Yeah, sure. Again, I'm talking long-term horizon, so that's why I made that allocation to equity. But you're right, I would potentially overweight the portfolio a bit more towards short-term liquid assets such as cash and T-bills and stuff. That would be my short answer.
Great. So last round of comments. Danushka, can we come to you? Okay, asset classes. I mean, what would you do?
Shamindra, I also agree with Chethana, right? So if liquidity is a requirement, then keep it in short-term cash instrument. But if you have the patience to basically look at the long-term, when I say long-term, the wait could be around minimum 12 to 18 months, right? Then, of course, the equity market, but in a measured way, because we are still in unknown territory with regard to seeing the price points. So, yes.
Got it. Thank you. I'll come to you, Nikita.
No
gun against your head.
Bonds, an actively traded bond portfolio. So a trading portfolio, I'm looking at a downward shift in the yield curve. So with the excessive liquidity that we foresee in the market for the next 1 year, no loan growth, possibly negative loan growth in the negative territory. So that's going to keep a lot of liquidity in the market. So yes, bonds in the short term, bonds all over the curve.
Got it. Udeeshan, same scenario.
In terms of short term, I would first of all invest in short term repos, deposits, keep it for the short term, but definitely look at coming into equities when there is a 10 to 15% decline. Fortune favors the brave, and I think there is real good opportunity in the market right now, given that good stocks, good value stocks with strong fundamentals have crashed so much. On the bond market side, my view was only 50 basis points reduction in the bond market in terms of active trading. So I think most of the money has already been made on the bond market, which is why I would kind of tend to stay away from the bond market.
Got it. And Dimantha, if I heard you right, Dimantha, before you answer this big question, you suggested that banks in general were trading at 0.4% of their book value right now. Is that true for the big banks? Dimantha, you have to unmute.
Yeah, 0.4 times. I think Udeeshan mentioned that.
Okay. So the if those stocks come off even more, you're buying underlying assets at a fraction, right? Okay. Your final comments. You have the money. Real estate is also an option, not just real estate stocks, but real estate as asset class. What would you do?
Yeah, so basically, if you really look at the bond market, basically, if you really look at the fixed income, I think basically in the bond market, the yields have significantly come down. However, the auction rates are 1 year going at 7%, but the market yields are trading at around 7.5. So yes, there is a possibility of the yield curve shifting downwards. But remember, yesterday we've had a 50 basis point rate cut. So immediately adjust on Monday. So with that, basically we will.
Dimantha, we lost you there. Okay, I think we have lost Dimantha's flow. All right, so I think we will also close the session from there. I think it's up to me to thank everybody who sent.
Further average down if you are already in your stocks and probably increase your exposure levels to the equity market, possibly looking at more longer term stocks. We prefer the telco, banking, the food and beverage, that sort of sectors that we are looking at. So at the moment, yes, short-term liquid cash, and 3 to 4 months, look at equity market mainly, because bond market, we feel that with the printed money, where currently there is about 300 billion, in a worst case scenario, we think it can go up to even 500 billion, then that will hit the exchange rate and also in turn hit the interest rates as well as we go on. So basically being liquid cash and slowly probably invest in a bit of equity, but as the interest rates are moving up, probably towards next year, you may want to gradually shift towards the fixed income securities.
Thank you very much, and thank you for putting it together when I dropped out of the call for momentarily there. So all that remains for me to do is thank everybody who participated actively. We had a large number of questions. I didn't take them by name, but I tried to cover everything that was asked about, right? Questions both on Zoom and on Slido. Thank you for participating so actively. Many of my questions to you in the last 45 minutes came actually from those who are participating on Zoom and Slido. Thanks everybody for getting in on this, and remains for me to thank everybody on the panel today. Chethana, Dimantha, Nikita, Danushka, Udeeshan, thank you very much for your time. Thank you for those frank comments when you could. I think you put a lot of data points and a lot of scenarios in front of us. The context was great. I think there is a sense that this is we didn't talk about COVID and its impact in isolation. We talked about the context, what's been happening in the market for the last couple of years, Sri Lanka's economy in the run up to this crisis, and then afterwards. So thank you very much, and best of luck and stay safe to everybody, all you panelists and everybody on the call.
Thank you, Shamindra.
Thanks, guys.
Thanks a lot.
Thank you. Thank you. Thanks.
Thank you, Shamindra. Thank you.
Thanks, guys. Take care.
Thanks. Bye.
Okay, see you guys.
Bye. Bye.